Ladies and gentlemen, once again, I would like to take the opportunity to welcome you back to our fifth session and the second session of the day. I would request everyone to please take your seats. I hope you've refreshed yourself. I would request everyone to please take your seats, and whoever is outside the auditorium, come inside the auditorium immediately, because we are going to be starting our next technical session on changing scenario of valuation in mergers, acquisitions, investment banking veteran with a knack of concluding large complex transactions. Sanjay has over 20 years of experience with a deep and on-the-ground understanding and exposure of handling more than 100 mid and large-sized transactions across a range of multiple sectors. Over the years, Mr. Bansal has developed an expertise on concluding complex transactions that require a nuanced perspective of the client's business as well as the macro environment impacting the client's decision. Ladies and gentlemen, presenting to you Mr. Sanjay Bansal. Now I would like to invite the dais the moderator of the session, Mr. Vivek Kohli, the senior partner and company founder, ZEUS Law. Mr. Vivek Kohli is the senior partner and co-founder of ZEUS Law, is a practicing lawyer since 1991. He is heading the litigation, arbitration, and indirect tax division along with handling the strategic side of the business. His practice area also includes corporate law practice, insolvency and bankruptcy, and banking and finance. Recently, Mr. Kohli was bestowed the honor of being appointed the Advocate General of the state of Sikkim. Ladies and gentlemen, presenting to you Mr. Vivek Kohli as the moderator of the panel discussion. As panelists, now I would like to invite on stage all the panel member. Mr. Rajiv Shah is the partner, RVSA Valuation Advisors, LLP. He is going to be one of the panelists. He is the MD and CEO of RVSA Advisors, a leading global independent valuation and transaction organization, advisory firm having 7 offices across India, Singapore, Dubai, and with a team of more than 250 plus professionals. He is specialized in mergers and acquisitions, financial valuations, due diligence, fundraising advisory, etc., etc. Ladies and gentlemen, presenting to you one of our panelists, Mr. Rajiv Shah. Mr. Vishwajeet Singh Jadon and Mr. Vishwajeet is BE Mechanical, is based out of Mumbai and has been in the valuation field for more than 3 decades. He has supported many organizations in setting up operations and helped many professionals starting their independent practice. He has trained about 150 engineers so far in the profession of survey and valuation. Mr. Vishwajeet is one of the panel members. Ladies and gentlemen, join me welcoming him. Now I would like to invite Mr. Kirit P. Buddhabati, a second generation valuer. Mr. Buddhabati is the founder chairman, International Plant and Machinery Valuation Conference Committee and founder member, Center of Valuation Studies, Research and Training, CVSRTA. His clients are Hindustan Levers, Murugappa, Tata, Siet, and many others. He is the former council member of the editorial board IOV, former president Institution of Surveyors, and he has attended conferences on valuation at Vienna. Delivered talks on valuation of plant and machinery twice at INSPN, a training institute established by the Ministry of Finance, Malaysia. Ladies and gentlemen, please join me welcoming Mr. Buddhabati. And in the panel, I would like to introduce and invite our next panelist, Mr. Ranjan Wadhavan. He is a graduate in commerce from the University of Delhi and is a fellow member of the Institute of Chartered Accountants in India. He has over 25 years of professional experience on advising domestic and international clients on valuations, transactions, mergers and acquisitions, corporate and financial restructuring, purchase, price allocation, business plan reviews, transaction support and modalities, finance raising, regulatory assessments, and corporate requirements of doing business in India. Ranjanji is a partner in Price Waterhouse and Company LLP and leads their valuation practice in India. Ladies and gentlemen, presenting to you Mr. R. Wadhavan. Please join me welcoming him. I would now like to invite to the dais our keynote speaker, the President, Institution of Surveyor, Kenya, Mr. Aroom Samoei, to say a few words.
Thank you. As I wait for the slides, as you've heard, my name is Aroom Samoei. I'm from Nairobi, Kenya. I'm a professional valuer with more than 10 years experience and currently the president of ISK. Luckily they've come. So that's a picture of Nairobi. Nairobi is the capital of Kenya. Kenya is situated in East Africa with 55 million people, 46 million people, famous for wildlife safari and athletics. Today we have one man trying to beat 2-hour mark in athletics. So ISK is 50 years old this year. So we are very happy to be here. We are very happy to be here to celebrate with IOV on their Golden Jubilee. We have various disciplines under ISK who are valuers, for which I am a member of the chapter. We have the land surveyors, building surveyors, land administrators, engineering surveyors, and geospatial surveyors. So all in all, the land and property sector in Kenya, professionals are members of ISK. The valuers are regulated under the Valuers Act. So before you become a valuer in Kenya, you have to be a member of ISK, do your professional exams after 2 years of industry experience, and thereafter you can be licensed. So on to the topic of valuations or emerging issues on valuations for mergers and acquisitions in the emerging markets. I think just as a background, corporations pursue mergers to achieve organic growth. So to say, to achieve economies of scale, acquire new technologies, and access other markets. All the stakeholders pursue value that is to be achieved through the acquisition. The valuation, as being a business, we look at it as a going concern, not the sum of components. As valuers, or as a property valuer, are more concerned on the real estate aspect, but when we are doing the business valuation, is a going concern. In valuations for mergers and acquisition, as they say, beauty is in the eye of the beholder, but valuation is in the eye of the buyer. So we would, as valuers, possibly go through the method of, the main methods of valuation, but the resulting value, which is arranged in values, should reflect these methods. The weight that we accord these methods would be determined by the industry in which the subject company we are valuing and the financial condition of the company. But how do we apply these methods? I think we would look at on whose behalf that we are doing the valuation, for what purpose. Is it for independent acquisition, group company, consolidation, or cross-border transaction? And when are we doing these valuations? Are we doing in distress conditions or when there's a boom? So what would be your role as a valuer in valuation for mergers and acquisition? It is to incorporate these specific factors and use the appropriate methodologies so as to come up with a figure that is deemed to be fair by the acquiring entity. Valuations would vary definitely in complexity, depending on the nature of the underlying assets and the liability and the information available. The fair value that would be the result of your valuation should be that the entity that changes hands between a willing buyer and a willing seller should be done in a situation where there is no compulsion or both parties acting knowledgeably. What are the standards and the framework on which we work as valuers in these valuations for acquisitions? The regulatory framework on which we work drives the process and the fairness in the opinions that we give. There are many legislations passed by countries to ensure that valuers are able to work or operate and give a figure that represents the true value of the company. So locally you may have the Indian accounting standards, the international financial reporting standards, and the international valuation standards. There is also other guidelines such as general anti-avoidance rules that are applicable to ensure that the taxmans get their due. In emerging markets, in as much as we are asked to do valuations for mergers and acquisitions, you would find that we are faced with poorly defined or enforceable contracts, weak regulation, and changes in legislation that affect the assumptions and the value that we assign the companies. There is also a weak adoption of the standards and transparency in these markets. Yesterday I heard somebody mention that there is a market, there is a black market, and there is a white market. These are very common in emerging markets. When you are evaluating company statements, you're not sure, is this the true position of the performance of the company? As a valuer, when you are advising on acquisition, are you giving fair value for the company? The uncertain global economic outlook on estimates make it very difficult for us to predict long-term growth. You would face very many challenges in the traditional valuation methodologies. You may find at times you may rely on gut feel or even experience to advise a client because of the challenges of applying the traditional valuation methodologies. We have event risks that happen in these countries, in these markets, that change valuations overnight. In developed countries, you would find growth is predictable, the industry is properly regulated, and risk profile quite low. So in conclusion, I would want to say the procedures for estimating a company's future cash flows at a discount, cash flows discounted at a rate should reflect the risks that are everywhere. But in emerging markets, these risks lie everywhere in your valuations. Thank you.
Thank you very much, Mr. Samoei. Now it is the time for our founder and managing partner from Aroom Equity Partners, who's actually chairing the entire session, Mr. Sanjay Bansal. And I would request him to come forward to the podium and say a few words.
Ladies and gentlemen, good afternoon. Members of the dais. Firstly, thanks for inviting us to this conference and having an opportunity to talk to all of you. I was speaking to one of my panelists and I got to know that the IOV valuation body actually is the largest in the country, constituted by 50% of the valuers under the new regime. And the other interesting statistic I learned was that there's a very healthy mix of academic background of people in this body. Engineers, MBAs, CAs. So it's a very eclectic mix of professionals, which makes this whole thing very interesting. And I'll put it in context as I talk to you. So let's first go back and saying, what is mergers, acquisitions, restructuring talking about? And why is it relevant to all of you? So as a practicing M&A and restructuring person for many years in this country, we've seen this segment of the market grow from few $billion to as much as $100 billion today. So the annual estimated M&A transaction market in India is $100 billion or thereabouts. And my own thesis is that this market is going to grow if the Indian economy is going to grow. So if you look at contextually, US, Europe, China, all the big economies which have large GDPs, you'll notice a correlation in the M&A market size and the size of the economy. Sometimes this market is domestic, sometimes it's cross-border, so it could be a combination. So I'll give you a small example. In Japan, which is a substantially large economy, right, $5 trillion and above, the M&A market is actually cross-border is not so large, right? This is important because you should know what field you're playing, right? The other interesting thing, which is a newer phenomenon in India, is the whole restructuring space. I know we've had this for the last 30 years, from SICA days, Sikh Industrial Companies Act, the various DRT regulations, under Companies Act winding up. There have been all kinds of forum to resolve distress in the country. But only 2 years ago did we actually put pen to paper and came up with the path-breaking IBC regulations. And with that came a whole new world order, at least in India, about how corporates who are in distress have to deal with themselves. And we did an interesting exercise we do every month. And in the last month's exercise, there were about 2,200 registered cases in IBBI, right? And there could be some margin of error, so I'm giving you an approximate number, right? And we then allocated these cases on the basis of phases. You have the phase 1, 2, 3, and 4 on number of days. So first 30 days, then you have the first, 180, and then 180 to 270, and then of course is the liquidation phase. And apart from the fact that this number of 2,200 has been growing at about 70 to 80 every month, right? And the value of these restructuring cases is an astounding, I would think, close to 70, 80 billion dollars, right? And growing. The 75% of the cases actually sit in phase 3 and 4, not in phase 1 and 2. And I'll explain to you why that is important in the context of all of you, right? So now we are dealing with a situation where we have a massive M&A market, and we have an equally strong build-up of the restructuring market taking place in this country. And unfortunately, if the economy continues to be soft like it is today, right, many of us, foresee that the level of NPAs may actually go up, right, on multiple counts in the country. I'm not even talking about the individual NPA regulations which have not come into play yet. So there is a very large restructuring market available to professionals at play in this country, which includes all of you. So if you put this whole thing in context, this session should actually be very, very important for you, right? Because a large M&A market and a large, restructuring market building up. Why is valuation important in this context, right? So if we look at India traditionally, we notice that, not traditionally, even today, we notice that valuation has multiple, uses and multiple relevance. So from the point of regulatory, where some government body asks us to do a valuation, whether it's income tax, whether it's SEBI, whether it is RBI, whatever, they have certain defined criteria, certain formulae, certain methodologies which they ask us to follow to do valuation for regulatory purposes. Then there is valuation for accounting, which is more relevant of the impairment of assets in this country ever since that happened, and the whole goodwill and brand valuation which came into play. So there's a whole accounting aspect of valuation, and of course, third is transactions. whether it's investment of money, whether it is a sale of an asset, brand, business, two companies coming together, and within that there'll be plant machinery. So, look at the context of how many types of valuation can be done by all of you, right? So, this market which you're playing, I just explained to you and demonstrated to you is large, A. B, the number of valuations which you're playing could be so many. You could do all kinds of valuations, right? And what each one of you could do will be a function of your expertise in what you're playing, right? But suffice to say that there is a lot of opportunity over there for you to do it. Was this happening historically in this country? Yes, it was. It was happening, but unfortunately it was happening in a very, very, how should I say, unstructured, myopic, limited fashion. So if you were a CA, by the way, I'm a CA by profession, I have all the respect for the profession, but I just thought that the way it was promulgated in this country, that if you were a CA, you were right to do a valuation, which frankly I don't agree with, right? Every time you are a finance background professional, doesn't qualify you for doing a valuation in the right way. But you were allowed to do a valuation if you were a CA firm. That was one perspective. If you were a government approved value, you could do a valuation, second perspective. And then if you were a merchant banker, you could do a valuation, third perspective. So these were the three more commonly used, what should I say, professional qualifications available for everybody who wanted to do some kind of valuation. And how many times have merchant bankers missed the pricing? 9 out of 10. That means all these people who are supposedly experts never got the pricing right. How many times have CAs made a mistake in valuation? Umpteen. How many times have government approved valuers, and please, this is not personal, I'm not trying to, rub anybody the wrong way. I'm just putting context to you in this new avatar, because the whole discussion today is the disruption and the changing scenario, right? So from that regime, courtesy Companies Act, courtesy IBBI, we now have a new avatar where they're saying you will be a registered valuer under IBBI, under Companies Act, and they've now for the first time come up with very nice guidelines, very nice, academic qualifications, expertise to actually, for people to walk the talk, for people to actually demonstrate their expertise in each of these areas. So all of you sitting over here actually are more qualified than your predecessors were, right? At least on the academic side. I'm not taking away something called experience, which is always an added advantage. So suffice to say that in this large market of M&A and restructuring, in this large market, in this changing regulation and qualification of academia who conduct these valuations in a professional way, you're actually in a very, very unique position. You should leverage it. And your uniqueness is further accentuated by the fact that, like I mentioned in the beginning, this body in this room actually comes from a very nice mix of people in terms of backgrounds, which makes it even more attractive, right, to do this job. Now, when I look at a typical M&A, right, and I put some context to the valuation, it's complicated. It's complicated in as much as you could be doing a valuation on the basis of stock market pricing because it's a well-listed company with good market cap, and therefore one argument is taken is that the stakeholders over here know what the value is, and therefore really do they need another value from someone, right, to actually consummate a transaction. But at the same time, we find a company is traded at, let's say, I'm using a number, 500 crores, but it gets sold for 1,000 crores or 800 crores. Why is that so? Right? It is not because one of us or one of you has come and said that this is worth 800 crores and therefore somebody will pay the money. It has many contexts to it. And one of the biggest contexts which is required to be appreciated is the value as perceived by the buyer, right? And what the seller wants. It's a bit of a mutual game. We may say whatever we want, but the truth be told that ultimately, right, the buyer and the seller more or less decide what they want to do. Now, because we're dealing with public market situations, we're dealing with listed companies, public boards, independent directors, therefore it's important that two parties should not agree something which is going to hurt the minority shareholders. I'm using this as an example, right? Therefore, it's very important that one of you steps in, right, and actually ratifies the number by appropriate logic and appropriate, calculations. And then one of the things you'll experience in these calculations, in the example I gave, is synergies. So somebody believes it's worth 800 because he thinks that he can have synergy benefit from this acquisition. But how will any of us know what the synergies are? How can we estimate the synergies, right? So I think point being made is put everything in context, right? You should have an opinion. You must have an opinion. You cannot say my client gave it to me and therefore I signed off on this report. Not acceptable. You must have an opinion. Your opinion can be caveated by saying we have not estimated synergies and therefore we are not able to opine on the value of synergies. Very fair argument. You're not supposed to know everything. But you're supposed to write your reports in a professional way. I heard Mr. Gupta in the earlier part of the session before lunch or before the break talk about, compromising, reports being compromised and how everything should be disclosed. Fair. But I don't expect everyone in this room to know everything. But what least we expect from professionals is caveating the report by saying this report is subject to. And sometimes going one step beyond that, if we were to actually put value behind this, this is the impact on the value of the business. I'm using only an example. I'll give you another example. I'm purposely picking up negative examples to make you think how the market is behaving. Let's say e-commerce. Income Tax Act requires valuation to be done by some valuer, right? And all the valuation is happening on the basis of some future profit, which will happen 25 years from now. Nobody knows whether profit will happen or not. Nobody knows, how this company should be valued. Two people have agreed, I want to invest $25 million and take 20% stake in this company. Now, how the hell will any of us value that stake, right? And what benchmark will you have available? None. I can tell you none, right? What do? You tell your company, make me a DCF plan, some Excel worksheet is made, and that worksheet is then signed off by saying this is a valuation report. That's what is happening practically in the market. Income tax officer is very happy that somebody is given a valuation report. Fact is, it means nothing. So there are situations in the market which are building up or which are there, which require some serious thinking through and serious professional, approach to conducting yourself in this market. You can't walk away from all situations saying, hum nahi karenge, because it doesn't make sense. You'll be out of business. So if you don't do bank valuations because bank wants, maybe, I'm using an example, or some NBFC wants some compromise in terms of your value, how many people will you walk away from? But you can deal with it. You can put caveats, you can solve the problem in a different way, right? But you have to, otherwise you'll be out of the market. So there are, of course, the regular valuations which are easy to do. But the context of evaluation is very important. The context of evaluation, what is the objective of the valuation, how it has to be done, right? Regulatory, non-regulatory, accounting, non-accounting, business, non-business, who's buying, who's selling, cross-border, domestic, is it a capital-intensive industry, is it well-listed, not listed? There are a zillion variables at play, which ultimately you have to factor in if you are the valuer. And maybe you are only one part of the valuer. You could be on the plant machinery side, you could be in the real estate side, right? Which is therefore a small part, or not a small part, but a part of the valuation exercise. So in an M&A, which involves, let's say, a business acquisition, what would we do? We would look at the earning potential of the business, very typical, nothing, no rocket science, right? We look at cash flows, no rocket science. We then look at the hard assets in the business, look at the value of these hard assets backed by one of the valuers. We look at, both for land building and for plant machinery on a replacement basis, and we come to some kind of conclusion. Sometimes courts in India like weighted average methods of picking up 3 valuation methodologies, giving some weight to it, making everybody feel good, right? The fact is, shareholders don't understand what's going on. They have no clue, right? I'm using a listed company context. They have no clue what's going on. They don't even understand what the swap ratio is. 80% don't understand. So effectively, it's the 2 people and the expert discussing these numbers. The responsibility you therefore carry is immense. What's going to happen in this country going forward, right? My forecast, there will be, businesses will get more volatile. You will be unable to project 5-10 years numbers. Your client will not know the numbers. How will you project the numbers, right? There will be greater failures in the market because of financial, trade, socio-political, geopolitical reasons, and therefore the whole business environment is very different, right? And therefore you have to value everything in that context. So all you could do is create deeper expertise and more focus in what you're doing and use that to build your practice. Couple of suggestions, if I may, right? I don't know the profile of all the people in this room. I take it that many of you are individual practitioners. I take it, right? We all know that when big companies do M&A or divestitures or even restructuring, then they want some big names to stamp the reports. I'm using the word stamp. I mean value, but read between the lines. But for all of you who are individual practitioners, you should build your expertise either in certain specific sectors, certain specific markets. So the feeling is, at least again personal view, that the SMB market in India will be very, very large. It is a large market, but it will have many failures, and those guys will want help and support, right? And they'll want to come to somebody who they can reach out easily, who's reasonably priced, at the same time will help them do the job. That's a large market. Some expertise in sectors is a good idea for you. Of course, land building, plant machine is a good idea for you. And most importantly is to be able to stand by your numbers, to be able to carry out the reports properly, right? And to make this learning a continuous process and not a one-time valuation expertise or qualification which you create for yourself. Like I mentioned in the beginning, on the restructuring side, there are 75% cases in phase 3 and 4. What does that mean? My own reading, they're all heading towards liquidation, right? If they're all heading towards liquidation, liquidation valuation becomes super important. Super important. And many of you in the room may have done it or will do it, right? So you have to think that far. You have to think that the value you give today will impact value 1 year from now, and the transaction 1 year from now. So it's a responsible, qualification. It's a responsible job which you carry, executed with all the ethics and all the caliber. With that said, thank you for being here, and look forward to a good session.
Thank you very much, Mr. Bansal. Now it is the time, of course, for the panel discussion. And our moderator, of course, the senior partner and co-founder of ZEUS Law, I would request Mr. Vivek Kohli to start the panel discussion. Thank you.
Thank you so much for that. Thank you, Sanjay. That was fairly illuminating on what you see as the market, where it's coming from and where it's going to go. So I'd like to pull in Rajiv over here. Rajiv, Sanjay just mentioned that, till some time back, maybe a couple of decades, just after liberalization, the the market was somewhere in the region of around maybe a few $1 billion, the M&A market, and now it's north of maybe $100 billion. Where do you see this going? I mean, as you see the stage of the economy and the stress that there is there, you see a lot of consolidation, and do you see the market actually booming as Sanjay feels for M&A?
Yes. So I'll split the answer in two phases. Valuation services for M&A is a derivative of M&A itself. India, as it grows, we are right now, what, $2.5 trillion economy as it grows. The M&A market typically grows at a pace which is 2 to 3, 2.5 times the growth rate in the economy. If I can estimate conservatively, M&A valuation market in India, which is spread amongst the top 20 firms, including merchant banks and some other firms, is conservatively estimated between 300 to 500 crore fee market. This market is generally open only to the top 10 or 15 or 20 firms. There is a huge opportunity for all the players sitting here that they need to come to that side of the market. It is an immense opportunity. And as said, market has been growing consistently 15-20% for the last 20 years. We were listening to the previous session on mortgage valuation, and I was getting a sense of that many people were sort of, there was a divergence in views. People were disheartened with the state of the market. But I can tell you with a lot of confidence that this is the market where the sun is shining. And it has been shining for the last 20 years. It has been shining for the last 20 years, but only if you look at it. Correct. So I believe this is a very, very important market, primarily, as I said, captured by, say, 15, 20 firms in India. This market requires a certain level of skill, reputation, and credentials. Because the client who's going to engage you, he needs credibility above everything else. He needs skill, and the market should know that you are skilled. So it is not that you are an expert, the market should know that you are an expert. So while all of us feel that we are experts, does the market know that you are an expert? Correct. That is the difference. So market should perceive you as an expert, and then definitely there is a huge, huge opportunity here. And I think this is a market which requires maybe more scrutiny, because all the players here are matured buyers. They're institutional buyers. This is not a retail market, it's an institutional buyer market. The clients are institutions, banks are institutions, everyone in its investors are institutions. These are not retail markets. So here, your credibility has to be there in institutional eyes. And that is what we need to focus on to build that. How do we build that institutional capability to be able to enter and capture that market? But I can tell you this is one of the best markets to be in. A few more comments. This market requires higher skill and capabilities. We need to be a visible expert, not just an expert, a visible expert. It requires higher degree of scrutiny. It requires your brand to speak for yourselves and credentials to speak for itself. I must also say that it is a very, very risky market. Now, let me give you a few examples. People feel M&A, disinvestment, restructuring. Disinvestment, whoever does it, is a minefield. Everyone wants to do it, but they don't know that they have to answer for 10, 20 years to CAG. And every time a Congress to BJP, BJP to Congress government changes, all cases are reopened. So these are risky markets. So you better be credible and you better be competent when you step into that. Even for all mergers and acquisition, the minority shareholder issues, the independent boards, the scrutiny which SEBI would ask, now the regulator is not sleeping. Chalta hai, ho jayega, keh denge, karwa lenge. Nothing is going to work. You have to be doing good and you have to be able to defend your work. The market and the regulator, be it tax authorities, they are suave, they are smart. The regulator of 20 years back is not the regulator today. He is expert. And otherwise, he will engage experts to scrutinize your work. So these are engagements which are high risk. There is high reputational risk. One bad case can bring the whole practice into question. So these are some of the thoughts. Again, and the stakeholders are minority shareholders, board of companies, regulators, SEBI, RBI, tax authorities, and the 3C, CBI, CVC, CAG, everyone is going to question your work. So you better be able to defend it. That's initial comments.
Those are some very interesting comments. It seems like the government is not your preferred client over here, yeah? But, it's interesting, some of the things that you said, but let me just pick up one of those things. So, Rajan, I'd like to pull you in over here. Amongst all the challenges which Rajiv just mentioned on, the market and as we go forward, which are the three key challenges which you would say exist for a fair market or a robust market to develop in India for M&A valuations going forward?
Yeah, I will take this forward from where Rajiv started actually, or Rajiv ended. See, the market has been evolving or growing over the last 20 years. I started perhaps my first restructuring in 91 and we're still doing it. The number and the volume of transactions has increased tremendously. Earlier, typically any restructuring, any reorganization would not attract that much of an attention by the various stakeholders, and that's where your question is. I look at it, the minority shareholders, there is more increased investor awareness. There are investor activist bodies which question any reorganization now. You've got the regulators scrutinizing each and every transaction. And thirdly, you also got the fund providers, which could be in the form of a debt providers. Earlier, you had a simple regime like there's a BFR, one group company has gone sick, and you would merge it into a profitable company. Now the profitable company shareholders will say, why should we take on those liabilities? So there are a lot of waters gone under the bridge now. Scenario is totally different. So you are going to see more and more scrutiny. When I do any of these transactions, I just put myself in the shoes of the external person, which is how will a minority shareholder view it, how will a regulator take it, and what scrutiny it can come in. Critical thing on this is having robust paperwork or being able to defend what calls you've taken. Valuation is not like an audit where you're looking at historical papers. You're thinking about things at a particular point of time, the way they are. And no one is a crystal ball gazer when he's valuing. Let's take a situation, NBFCs a year and a half back were, I just got an NBFC license and people were valuing it at n times the NAV or the book which you're running. And today you just look at it, the situation is totally different. Let's look at Yes Bank, right? Already an erosion of 70-80% in last 1 year. So valuation, one does need to keep in mind, it is at a point of time, the purpose or the objective of valuation, and the constituency to whom you're catering. These three things I would keep in mind whenever I'm doing a valuation in the context of any merger, acquisition, restructuring, or anything of that sort.
Fair. Okay. So, Mr. Buddhabati, one question for you over here is that, one of the points which Rajiv raised and what Rajan also just mentioned about, one of the issues is that after the entire exercise is over, then, hindsight is obviously 6x6 vision, and then you have the 3 Cs or external agencies which will look back on a transaction in hindsight and say you did this wrong or that wrong. Now, I have a question specifically with this background for you. Only recently, one of the most eminent lawyers of this country said that, the telecom and the coal sectors are today actually in doldrums because of judicial intervention. And because, the licenses were cancelled, mines were cancelled, and then, obviously the new method of valuation for farming out these assets was auction, and which has caused so much stress on the business that now it doesn't allow them to perform profitably. How would you look at this situation?
See, can I, before answering your question, say something on 2 sentences he mentioned, value to the buyer and value to the seller?
Please go ahead.
See, friends, value to the buyer and value to the seller, they are different, and how they are different. Value to the buyer is the capitalized value of the additional income generated due to acquisition. Whereas value to the seller is the deprivable value. Now, I'll give you a classic example of one, merger acquisition of a cement plant. One cement plant was to be acquired by another cement plant. The plant which was to be acquired was valued by the valuers very scientifically, no hanky-panky, at A value. The owner of that plant was fully aware that the other, plant owner badly requires this value. And ultimately, transaction took place at 2A. Though the good market value was 1A, transaction took place at 2A. And there was a very big hue and cry amongst the shareholders, why you are paying 2A. Then managing director gave a very good explanation to the shareholders. If I go for a greenfield plant, it will minimum take 3 years. I have so much order with me, which I am not able to fulfill with the plant that we are having. So we must have this plant. In spite of paying 100% more price, the profit that we are going to bring is so much. Now you tell me, whether should I buy a 2A or not? And ultimately, transaction took place at 2A. Now here, 2A is the price paid. It is not the market value. Now suppose if that company which acquired at 2A wants to go to the bank and bank has to value, bank should consider only A as the value, because market value is A. Now coming to, see, we as valuers are not concerned with the synergy of the buyers and sellers. We have to give an objective value of the assets which we are valuing. Once a student asked me a question, sir, you are always telling a good report, good. What is good valuation? I said, a good valuation which can withstand the test of the cross-examination of honest and intelligent attorney. If you do that, then fine. All the synergies we are not concerned. This is value to the buyer and value to the seller. Now, coming to you, you see, as a valuer, when any problem is given to him, valuer, he has to consider all the aspects which are relevant for valuation. Whether, say for example, recently I was going through somewhere and Rajiv, I contacted you and for the mining, some problem was there, and I said that this is the circular which the government has taken out. I am not happy with this, how it can be. It was, you see, whatever the licenses that you have to get the material, that should be always in place. Because value is inclusive of everything. Now, if you want any further clarification on whatever I said, please ask me.
Okay, so I'll just take that forward to Sanjay for a moment. Sanjay, you had mentioned about, synergies being important. And synergies are many times because really maybe sellers in today's market really have to make all the disclosures about what their assets are. Buyers possibly don't have to make that declaration when they go and look at purchasing all these things. So the synergies, if they are missing, now there are three players over here. One is really the buyer, the seller, and then the silent stakeholder, which are, let's say, minority shareholders, or in a public listed company, the shareholders who don't have access to the negotiations. How do you balance amongst the three? How do you balance this synergy question?
So, Vivek, my explanation on synergies was as an example to say that valuers independently cannot estimate synergies. They just cannot, right? It's impossible. So the reason why I brought that example was to demonstrate that if value A or 2A, like gentleman mentioned before, one of the reasons could be some synergy in his mind, right? Which you'll never know. As long as you are preparing your reports, caveating appropriately what you don't know, you should be doing fine, number one. Number two, if you are dealing with public listed companies, right, more so, or where you have minority interest, then both the buyer and the seller have to explain the value. And to that extent, whether you value the synergies after discussion with your client, whether you have the knowledge in yourself as a firm to value the synergies, it'll vary case to case. But I think in the context which you just mentioned of public listed companies with minority shareholders, explanations are required very often about your valuation and your basis, and you can be subject to scrutiny, including for valuation you may have given to non-tangible assets.
Now, Anand, question for you here. So, one of the things which came is that if it's a listed company, then you have a historical share value and you can figure out exactly what the price is. But another aspect of it was that there's a difference between value and price. So, the value may be theoretically whatever it is, but the price which a willing buyer is to pay. So, in the absence of price discovery, let's say SMEs are going to be like a fairly important market. So, in the absence of any price discovery mechanism, how do you again, go ahead and balance out these aspects?
See, the valuation is not to balance out these aspects. I'm answering this as a valuer. The question is very valid because price discovery is not there. So that's why the valuer is needed. So valuer's job is not exactly to adjust any kind of requirements of the two sides, but come out with the independent opinion on the value, and that can happen by a process, and all of us are trained in that process. So the first part of the process is that the valuer must understand the scope. What is the purpose? Now, if you know the purpose of valuation, then you will design your process for that purpose, what is suitable to that purpose. Then while going through the complete process, now I will not elaborate on the process because everybody knows the process here. They are all registered valuers. So whatever outcome is there, all I need is to be very confident about it. I am least bothered that there will be challenges on it. There will be somebody pulling on this side, somebody pull you on the other side. But if I have done my job very, very neatly, very, very correctly, and with my conscience and my ethics and the complete process, and I have confidence, faith in my process, then whatever outcome will come, and you will find a situation, this outcome of valuation will be eventually acceptable to both the parties. So there will be a solution to them.
Sure. Rajan, you wanted to pull in on this?
See, I think the important thing which one does need to keep in mind is the distinction between price and value. Price is what you pay on the basis of negotiation between a buyer and a seller. And the value can be totally different, which is a willing buyer, willing seller concept. So one does need to keep into mind these things. The synergy and all those benefits get factored in when you're paying the price. And the negotiation ability of the seller also. That impacts the price which you pay. But the economic value of an asset, that is independent of these synergies or all these benefits. So when you get into a purchase price allocation, yes, you do look at a lot of these things will be there because you're allocating what you paid in the market, and the fair value can be totally different. Whereas when you're talking about only a fair value is the same. Yes, if you were to be a seller or a buyer in a market which is independent of influences. So a lot of the friends over here must be doing liquidation valuations, and there's a session after this on this also. That's not a fair value. Fair value, typically the term comes into play when we do talk about the accounting aspects into play.
Also, Vivek, just to add there, I mean, the concept, and I'm restricting my conversation to M&A for companies, not mortgage real estate values. We say asset values determine the values, but practically, my question to my fellow professionals here is that how many asset transactions happen? We all do valuation, but have they ever been tested in the market? How many steel plants have been sold as an asset? How many cement plants have been sold as an asset? How many shipyards have been sold as an asset? Sir, I did all the 4 shipyards and all the steel companies which were sold recently. There was not a single steel transaction prior to that. Not a single shipyard transaction prior to that. So what is a fair value? Is there evidence available in the market? Zero. All of us, there is zero evidence available in the market. Asset markets are extremely shallow. Extremely shallow. We are not talking about selling of flats and lands. I'm talking about huge assets. Now, asset markets are extremely shallow, therefore all the valuation which are done are non-market based and therefore very, very risky. Because it is your estimate. There is no evidence to prove it. As valuers, we are students of the market. But where is the market to study? There has to be a market. There has to be evidence in the market to study it. If there is no market, then all our valuations have a potential of going horribly wrong.
See, when you do a valuation and now you're trying to compare with the transaction, you must understand, like Rajiv said, there is no market, there is no precedence available. The situation is very complex. But you must understand the difference in the value of selling a company and the value of those assets. And that's why I mentioned the process. Now, when you know that there is no market transactions available, then market process cannot be applied. You have to look into other processes also. And then safeguard yourself that I am doing by this process. But the end outcome, the challenge is that it may not be suitable to any of the sides, buyer or seller.
But I have a controversial...
Go ahead. Everybody seems to have an opinion. Please,
I have a
Sanjay,
controversial view to Rajiv. Sorry if I may.
Please.
I don't agree with him. Right? I don't think that there is no concept of asset pricing. There is a concept of asset pricing. It happens. There are industries and assets which get traded on asset basis only. The relevance of earning potential is lesser. Asset is more. And the examples of steel and cement are classic cases where asset pricing is very important. Right? And this is what I've seen in many situations I've been involved in. The other thing I notice when we're dealing with, we don't play that market, but when we interact with people in the SMB side, and this is now not about the asset pricing, mostly two people discuss valuation from net worth, right? Or the underlying asset. In this case, it could be plant, machine, or real estate. I'm talking the SMB market. So in the SMB market, asset pricing plays an even bigger part. In the non-SMB market, which are the larger companies, it varies on the basis of nature of industry. So, due respect.
So the point was, see, sometimes asset values, see, we are all asset valuers, they are 90%. So asset valuers feel they have a false sense of security कि हमारे पास asset है. Asset है, लेकिन उसका value इसलिए नहीं because there is no earning potential. The problem with all the bankers, they have a good-looking power plant producing 0 megawatts of power. They have a wonderful steel plant lying closed for 5 years. Now, while there is an asset, is there fertilizer plant? No urea. Power plant? No gas. Now, how are these assets going to be valued? They look good. They are wonderful assets, but asset values will definitely give the bankers a false sense of security. More and more bankers will approach you कि मुझे asset value चाहिए होटल का. अरे कोई भी होटल never transacts on the basis of asset value. It only transacts on the basis, hotel is as good as a factory. Now, it cannot be demolished and rebuilt. That's a completely different project. So, most bankers will come and tell you, I want asset values. And you may find in that in many cases, not all, in many cases, asset values have become so irrelevant, outdated, and they give a complete false sense of security to the buyer, seller, banker, everyone. That's my view.
So let me just pull this back for a moment. Let me just pull this back for a moment and bring it out to one of the other points which Sanjay had said in his opening remarks that was relating to e-commerce valuations. Now, we've been, as a layperson from outside the area of valuations, there are 2 or 3 things which come to my mind. The first is that, we had the dot-com burst in 2000, and then we have the exotic derivatives thing happening in 2008-9, and now this e-commerce valuation which is going on. Frankly, I have very little understanding of how these businesses which are going to produce some profit 20 years from now are getting valued. But would any one of you like to take on this question and really just give let's say, just a little bit of a outline on really how do these businesses, are we looking at another, it's already 8 to 10 years, and are we looking at another, sort of...
Should I try?
Flip happening?
Okay,
Please.
so I'll give a shot at it. So I'm an angel investor. I do invest in many of these early startups, right? I hate to tell you this, right? It's a dartboard, right? You look at the team.
That's the term I wanted to use, actually. It's a black hole, and you don't...
You look at the team, look at the founder, you look at the sector. Really, depending on what stage you're entering, you don't know more than that. It's intellectual gambling, right? To a large extent. When I speak to investors who invested in companies which are seeking round 2, round 3, round 4, they themselves don't know why a new guy gave a high valuation. I'm talking about institutional, qualified, highly reputed names. But I don't agree that this is a phase which will, it's a bubble which will burst. I think there's a change of business order taking place in the world, and it's the way we do business is getting replaced, and to that extent, not in all cases, but in many cases, the valuation is arbitrary and very rich and sometimes unreasonable. That's what's driving it. That's my assessment. There'll be some rogue cases in the market, but that's not always the matter.
Ranjan.
See, I think it's disruptive technology at the end of it, right? It's coming in place. You will have cases, some of them will succeed, you will have cases which are going to go bust. Each round of this investment, it's like a Ponzi thing, I say. Each round happens at a higher level, and then it's a question of how well you can palm it off onto the retail guys or the wider this thing, how you can distribute it. WeWorks is a classical example right now. The valuations were taken up to 47 billion, and then suddenly, closer to the IPO, now they're talking about the valuation being around 10 billion. Well, I don't count WeWork as a tech company. I thought it was always a real estate play with this thing. But yes, let's talk about things which are happening on digital marketing. Who had thought about digital marketing being at what prices it was being bought at? All those companies were being bought at, say, 3-4 years back. They've actually started generating revenues also. So it's also a question of whether how good or bad your faith in the business model is. The promoters, or whether you're backing the horse or the jockey, right, is a very favorite term which we use in this thing. You need to have faith that yes, this idea can click, cannot click. You are shooting in the dark, but digital marketing is there, artificial intelligence is coming in. Let's look at WhatsApp. No one had believed that they will be able to start generating. They will be able to. Now they are coming up with some revenue models in place, right? So some of them will succeed for sure. They will take away a lot of our traditional ways of valuing. What he was talking about on the asset and all that, I think that's something which you can discuss later. Also, people can have different views. I may share Sanjay's views on that you can find that. But
see, first I will talk about what Rajiv said about the specialized assets. See, Rajiv, I do agree that, these are the assets which have no market and difficult. But then you have to write in the report, this is the limiting conditions under which I am working. This being the limiting condition, my approach is this. I am linking with my income earning. What is the income earning and how much income it is going to draw? And based on that, but then when you apply income approach, that time you have also to remember, one interesting case came up before the Bombay High Court. Raptakos Bread sold some business to their sister concern Kunal Pharma in 14 crore or something like that. Now to that, one of the minority shareholders took the objection that you have done entire valuation of the business at 14.5 crore, but actually the company is having the land worth 200 crores. So this valuation is not correct. So the council of the company argued that we have done the business valuation, and business valuation means net current asset, fixed asset, and working capital, net working capital. And that's why it is, all the land is included in valuation. That is not correct. See, the income which is generated by the productive asset or the assets which are in the production, they are responsible for income generation. But the assets which are surplus to the manufacturing activity, that you have to value on the highest and best use basis what it will fetch in the market. Similarly, in your case also, if there are any surplus assets, you have to value like that. And another, shall I say on the digital market and all?
Yeah, please,
Yeah.
feel free.
You see, income, I am Gujarati, I am Rokda wala. So, anything which brings the value, Rokda has value, which does not bring the Rokda has no value. Now you see, when you are, just a minute, I just missed.
Yes.
You see, business valuation. Now, BE minus NWC is equal to FA plus IA. In any business, the income is generated by fixed assets as well as intangible assets. We must have seen one company is not doing well. Hindustan Lever takes up. With the same assets, it is making profit. What is the reason? Because their human resources has generated the income. So we did one valuation of one IT company. There, we had assessed all the human resources. What is their capacity to generate the income in future? Because their IR is more, fixed asset is less. But, in any valuation, B minus NWC is equal to FA plus IA. Some have more IA, some have more FA. That is important. And another thing, Rajiv, what you were telling about the bankers. Bankers are making not mistakes, but blunders in India. By accepting, you see, they are not advancing on value, they are advancing on cost. Whereas Section 5N says that the market value. See, plant is put up, 200 crore plant is there. They keep some margin and give 150 crore loan. But what is the income generating capacity? Now, if you see the statement of asset valuation practice of RICS of 1991, they have clearly mentioned that specialized assets are not good for security. So what is the earning? You don't get the earning, you just give the finance based on the cost of the product, cost of the asset. And that's why all these problems, these problems are because...
Which again possibly brings us to the third concept, which is cost, value and price. All three are fairly different concepts. But Mr. Samoei, one question for you. Ladies and gentlemen, since we have, a time constraint, what I'd request is that we carry on with the session and the question and answers, if you'd permit, whoever has a question and answer, please feel free to ping upon the panelists during lunch hour, and I'm sure they'll be happy to answer any questions that you have. So, Mr. Samoei, one question for you. Two of them actually. The first is really when you look at India from the outside, what does the scenario look like? I mean, as hazy as it's coming across, or does it seem like a lot clearer?
When you look at India, it looks to be a fairly entrepreneurial market. So there are opportunities for growth in companies, and in those situations, when you want to expand inorganically, you may want to acquire, and you'll be looking to exit. So we see the opportunities that India possesses.
Gentlemen, I said you could ask the questions during lunch. I didn't announce lunch. Lunch has not been served as yet. Please take your seats. Yes, please. Yes.
The other thing that we see is India has tapped into the global capital markets because of its big pool of investment and talent. So it's able to attract huge capital into India. And we see a lot of support by governments to support that kind of initiative. So India is a place for corporations to do business and grow and acquire, divest. Yeah.
So, Vishwajeet, the next question is for you really. If you were to look at the next, let's say, few years, which do you think is the biggest disruptor that you see in this market? What is the next big disruption going to be?
There are a lot of disruptions. The one bigger disruption is regulation. Lot of compliances. We are now in the age of compliances. So, but compliances are meant for making a system better. And sometimes in our great country, it happens otherwise. Compliances become too much, and then you lose your sight. What you were supposed to do, instead of that, you're doing compliances. So this is just one minor point on the disruptions. It should be conducive, but we are not seeing it that conducive so far. The other disruption is the market itself. Like, it is changing so fast, and every other day some companies collapsing. You have so many cases in IBC. Now you have challenge for valuers doing those jobs. And technology, as we have discussed in earlier sessions, the disruption will come from technology, and that will be affecting not the entire market, especially not the merger acquisition. That already discussed, it was affecting real estate. In this market, there are not many disruptions as I see. There are only opportunities that are going to increase. If you are well skilled and you are training yourself continuously and keeping an eye on the context, the changing scenarios, you can have a merger acquisition valuer in a normal situation when a company takes over another company for the betterment of both the shareholders of both the companies. It's a value addition to both. That is the ideal situation of a merger acquisition. But now more and more merger acquisitions are happening on resolution. Now there is an erosion of value of the existing company, and there may be some value for the new company. Now valuers have to be in loop with all this. Valuers must understand the concept and the context of the market. What is the purpose? What are the situations? See, for example, as Rajiv mentioned, the power companies. Now, he mentioned about the power companies not having gas, the plant is put up, how to value it. I have seen power companies having good plant, very good technology, and they're producing 100% of their efficiency. They have 85% covered by the purchase price agreements, is still making huge losses. And still they have to go for resolution. and the resolution pricing comes out to be almost 50% haircut. So these are all the challenges, and they create some kind of disruption, because if you don't know how to do it, then it's a disruption for you.
Okay, Rajan, question for you here. Vishwajeet just mentioned about the regulation itself is many times a disruption, but you also have an issue about convergence of laws. So you have the SEBI rules or the SEBI regulations require valuation in a certain manner versus the income tax versus the Companies Act. So there are different methods of doing the same thing. Do you see that as a problem, or do you see that converging at some point of time?
Yes, today it's a problem, but I see convergence of all this happening in another couple of years. Right now, because the IBB has introduced this concept of registered value, so and registered value is required primarily for any valuations which are getting carried out for Companies Act and insolvency cases. Income tax still requires chartered accountant, merchant banker. Now, in the context of an M&A transaction, you have a situation where you may need 6 valuers getting involved: a merchant banker, a chartered accountant, a registered valuer from a buyer's perspective, and similarly from a seller's perspective. So the cost of compliance will also go up. The opportunities for everyone will grow up for sure. But everything has got a cost-benefit analysis someone needs to do. So I do foresee some changes happening in another couple of years. You will have convergence on all of this happening. The challenge which you have for tax valuation is they are very rule-specific and formula-driven, unlike the business valuation which you may do for an M&A transaction. So we don't know whether they will change that fast or no, because they still go by the cost principle vis-a-vis the earning principles and all that, in that sense.
That's interesting. So, gentlemen, it's already 1:50. So, final question for all of you, and I'd like each one of you to answer this. Which is the next sector you think which is actually going to be, like we've seen the banking sector go through this entire exercise after, accounting for all the NPAs and the revaluation that went in. Which do you think is the next sector which is going to be, and we'll start with Ranjan and then we can come to...
So had you asked me, had this conference been 2 days earlier, I would have easily said capital goods, and it's already out. The data is already there. We've already seen the meltdown in auto, NBFC, now capital goods. So let's see the other ones.
See, those who want to do the work, that always comes. Since 48 years I am practicing, for one sector is down, other sector is up, something or other work is always coming from.
Sir, I believe rather than sectors which will go bad and will become NPA next, I would say valuation will do well. Because whatever happens, wherever there is a change, people will need valuation. Market going up, people will need valuation. Market going down, people will need valuation. We have to pray that the market does not remain stagnant. As long as it is doing something, we are good. Now, but the key point I would want to say is, and there is a lot of question which I had with the previous session also, is for the valuation professionals, is for the biggest, possibly $1 million question for all of us here, is that there is a huge market here. It is good. It is very good in pricing as well. But would the professionals, the large set of professionals, will they display the leap of faith and reskill themselves to jump in?
example, in 1971, when I started a practice in Mumbai, that time, there was not a single valuer who was working only as a valuer. All civil engineers and architects as a second line profession were practicing valuation of real estate. And everybody was asking me, you do have sufficient work? I said, up till now, so far, there is no problem. Then slowly, I started my practice. I had a staff. Then I had a staff of only 4. You have a staff of 4 person. Are you getting enough job? I said, valuation field is going to be like this. And now see this, my student is having 160, or number has increased, tell me, 250. Then there are people having 40, 50, there will be so many here. So this is what is the opportunity for valuers. Thank you. Thank you for giving me extra time.
Thank you so much, gentlemen. This has been a very, very nice invigorating session, and I hope the audience enjoyed it as much as I did moderating it. And it's up to you.
Right. Thank you very much, Mr. Kohli. And I think indeed it was very, very informative and a brilliant interactive session. Can we have a big round of applause for Mr. Kohli? And now it is the time for the felicitation. And I would like to invite the person who has actually chaired this entire session, Mr. Sanjay Bansal. And I would invite Mr. B. Kanga Sabhapati to be on the stage to felicitate him.